Anyone trying to join now? 14 participants are there. Okay, let's start. Market risk arises due to changes in market prices, sources, interest rates, exchange rate, equity, and commodity prices. Management, hedging, diversification, and asset allocations. Interest rate means changes in interest rate. We already discussed about loan interest rate. When we take loan from the bank or finance institutions, there are two options that you have to select a fixed mode or floating mode. Fixed mode means where the rate of interest will be static. There will be not any changes in future. Same rate will be for the duration of loan period. But in floating rates, rate will be vary or change depend upon the policy of RBI and governments. Okay. For example, you have taken loan on a 9%. This is just an example. Okay. And you have selected mode, floating mode. And in future, if rate increased, you have to pay extra interest. Okay. For example, rate of interest increased by 10%, 11%. Okay. Then you will be in loss of 1% or 2%. Okay. But what's happen when interest rate will be getting down, down, down? For example, on 8%, 7%, it may be happen. We can't judge it. So we have selected that floating rates. It's total our risk, personal risk. Hmm? Whether to take floating rate interest rate alone or fixed interest rate alone. Okay. Exchange rates. What is exchanges? Currency exchanges. When our government exchanges currency with other countries, rate of interest and rate of exchanges may be vary. Okay. You may know about a rate of dollar. Currently, the rate of dollar may be up to 89 rupees for Indian rupees. Means if you have to take $1, you have to pay 89 rupees for that. Okay. But when we have purchased that dollar in 89 rates and suddenly a rate get down and the rate of dollars fallen up to 81%, what will happen? There will be loss of 8 rupees per dollar. Okay. This is a example of exchange rates. What about equity and commodity prices? Equity means purchasing only shares of other companies, whereas commodity means the products, things, raw materials, just like gold, silver, and others. Commodity market is very high level market in India, as equity market is there. So there may be changes in the rates and fluctuation will be there. So this is also called as market risk. So how to manage these fluctuations of interest rate, exchange rate, and equity commodity prices? So there is a management. For example, hedging system is there. When you transact in a share market, hedging system means you can fix a location where you will not be get loss more and more. Means you have buy shares for a rupees 1,000 per share. Okay, and uh, you are expecting that your rate of shares will be increased by 1,500 or 2,000 or 3,000, but you have set the hedging on 9,000. Means if there is a downfall in share rates, and share rates downfall up to 700, but you have set hedging up to 900, so you will not get the losses of that 200 extra. Another example is diversifications. Means when you get the idea that there will be fall in the rates, you can divert your shares, your properties, or your investment in other sources where you can assure, or you will be assured that there will be maximum profit. Another example is asset allocation. Asset allocation means making investment in different areas. I have already shared an example that instead of to invest in share market, you can manage 1 lakh rupees, just like 30,000 for share market, 30,000 for fixed fixed investments in banks, 30,000 for other purchasings, and remaining for others. In this way, you can divide the risk. Means you will get losses in some systems, but you will get profit in another system. Means your average will be managed in this asset allocation system. Credit risk, risk of borrower default. For example, loan default. So many shareholders take a loan from the banks, finance institutions, and not repay that loan. So they will be defaulter of that bank or finance institutions. Okay. So how that loan is secured is depend upon that financial institutions or bank. Okay. Or non-payments means personal give and takes. Okay. Borrower came to you and asked that please help me and pay me few amount or a few raw material. Means he can buy raw material or other products also from you and will not pay your payment. So you will be in loss or in bad debts. Okay. How to manage this credit risk? Credit analysis means before to lend money to the borrower, you should have an analysis of that person. Means check the credit of that persons or that organizations, that whether it is a defaulter to another organizations or not. In bank, they check this with the help of our PAN card number, because income tax department have our complete records about how much loans we have taken from institutions. So we can check this with the help of CIBIL. So everyone is interested to make their CIBIL strong. Okay. Setting credit limits instead of instead of to give higher loans, we can set a credit limit. Means if there are defaulters, you will be get loss of low rates. So you should have to set the limits of your credits. For example, you are paying 1 crore, 5 crore, 10 crore loans, and you have set the credit limit up to 50 lakhs. Means your risk will be down. Collateral securities means when you give loans or credit to anyone, any organizations, you must have to take collateral securities. Means you should have to hypothecate the property of that person. You should have to take checks of that person. You should have legal agreement of that person's. You better know about Satbara Utara. Hmm? You should have to connect your loan with a Satbara. Means 7 divided by 12. Means when that person or that organization will take loans from other institutions, they will check the Satbara, whether it is clear or he has taken loans. So he requested that you should have to pay your previous loans or credits. After that, you will be allowed to take new one. Okay. And another is credit insurance. What it, what is credit insurance? Means when you give loan or credit to any borrower, you should have to insure that person or that uh, transaction. Okay. What is the benefit? The benefit will be if that person get died, okay, or that organizations get bankrupted, then what will happen? You will be assured by the insurance company to repay the amount of that transactions. Okay, when a person died, his general insurance is there, and due to that general insurance, you are the nominee of that insurance company, that loan case, and you will get a repayment from the insurance company. Okay. So I already discussed the insurance companies, life insurance and general insurance. So general insurance companies are there. National general insurance companies are there. Four companies are there in India. National Insurance, Oriental Insurance, New India Insurance, and another is there. These types of insurance companies are there. But nowadays, other private companies are also there. Those are providing life insurance and general insurance. But the claim settlement ratio is higher of government than other private institutions. So maximum persons are trying to get insurance or get insured from government life insurance or general insurance, because government will not deny to pay the claim amount, because government has so many amount, too much amount. Liquidity risk, inability to meet short-term obligations. Types: funding liquidity risk, market liquidity risk. Liquidity risk means the risk of becoming legally bound to compensate or to pay for damage to the person or property of others. Means when there is accident, and due to that accident you made losses of other properties or other cars, what will happen? You must have to pay the amount of that losses to that another person. Okay. Management, cash reserves, forecasting, credit lines. How to manage this risk? Means you should have extra cash, cash in hand or cash in bank to repay the amount of these types of liability risk. Forecasting means you should have to insure yourself, your car, and your property. Okay, means in insurance system is available that third party insurance. When you make an accident with another vehicle and the owner of another vehicle is get died, what will happen? The amount of that person will be paid by insurance company. Okay, means this is the system that you can secure yourself also. In finance, credit lines, credit lines also there. So you should have to secure yourself liability with the help of credit lines also. Operational risk, failure of internal processes, people, or systems. For example, frauds. Our employees or unsatisfied employees stolen few amount, few material and sold to external entity. What will happen? We will get a loss. Our company will be in loss. Huh? So this type of frauds because of disgruntled employees or unsatisfied employees. A few times what's happened, few in corporate level, few employees can share and so sell the ideas of our company to another company. They will get maximum amount of that ideas. Okay, so the rival company will pay them huge amount. Okay, already we have seen this in a movie, corporate movie. You can see corporate movie that how employees can make frauds, system failures. Okay, means when your system is crashed, whether it is of computer, internet, or machines are not working, they are under maintenance. So your production system will be totally stopped. So what will be happen? Day by day, your production will be stopped and which will affect on your finished goods. And when you will not available the finished goods, what will happen? You you will be in loss because your interest rates are in running. You have to pay daily expenses, rents, wages, stationaries, other bills, just like electricity bills and others. So this will be hamper your business. Human errors. Due to human error, there will be losses. For example, few employees do not wear security things while working in the operation mode. What will happen? There will be accidents. For example, hat is compulsory in operational systems where you are wandering here and there. You must have to wear hat. That hat is of fiber. Means any accident can be happen with you or occurred with you. You will be safe when we are on the bike, we are suggested that we must have to wear helmet. Why? To save ourselves, to save our head, because head is the main part of our body. When it is get injured, what will happen will be unconscious. Okay, so the major focus given on head. So helmet should be wear by us while driving the two-wheeler. Do not hesitate or do not forget. This will help your life. And we have our family background. So there are so many family members. So they are rely on us also. So save ourselves with the help of helmet also. Management. How could we manage all this risk? Internal controls. Okay. Means just like spy. Government also apply a spy to get the news of terrorists and others. The same system is followed in corporate system, that a person is appointed to be touched in every employee or every systems to get their news, whether they are satisfied or unsatisfied, or are they trying to create any problems in the organizations. So you should have to appoint a person for your intelligence. Insurance. Insurance is most important part of every organization, which is already we discussed. Risk audits. Risk audits means checking previous records data to analyze what is the level of risk, whether it is high level risk, middle level risk, or low level risk. Legal and regulatory risk. Risk from non-compliance with laws. Example, regulatory penalties. In bank, if bank do not supply the record of creditor to RBI, what will happen? RBI will punish banks or financial institutions on high level amount. For example, 50 lakhs, 1 crore. It's depend upon the amount of balance sheets. Okay. So the records must be provided to the RBI by the financial institutions or banks, every banks, whether it is cooperative banks, private bank, corporate banks, national banks. Contract disputes. If when we do any contract with any kinds of institutions or persons, we bind everyone in different types of terms and conditions. But when any accident or occurrences are there, another party reject to accept that terms and conditions. So dispute will be arise due to non-acceptance of that terms or conditions by the person or by the organizations. Management. Compliance program means when any situation is there or a national calamity is there which hamper your transaction, to provide your transactions to RBI, you could request to that RBI that due to this reason we were unable. Okay. So in this case, RBI will think about to pay you the charges. Okay. Or government will think about to pay the charges or penalties to you or not. It is totally depend upon your convenience in the letter. How the wordings of letter is very strong to convince them. Legal reviews. This is another parts. Nowadays, many contracts, MOUs. You may know MOU means memorandum of understanding. When you do every MOU or contract, you must have to notarize it. Means under legal compliance. Means the value of that terms and condition will be increased. Nowadays, we have seen that we purchase so many things from the market. Even we have take sign up of different types of companies in online mode. We always not reading the terms and condition. We just click on that checkbox that accepted terms and condition and submit that terms condition. But we must have to read all the terms and conditions to avoid our personal losses. If we do not understand that terms and condition in our own language or regional language, the best system is that copy that terms and conditions and paste in translategoogle.com. Translategoogle.com is the best dictionary in which you will get different types of languages. There are available Marathi language, Hindi language, Gujarati language, Kannada language, Telugu language, even Sanskrit language is also available in Translate Google. So you must have to install Google Translate in your mobile to verify any new words, the meaning of new words. Nowadays, we are not able to get the meaning of the words from the dictionary. We don't have time. Okay. So we have the mobile and we must have to use it thoroughly. So I request you that must install translategoogle.com in your mobile to check not only a single word, you can copy and paste paragraphs also. Even if you want to scan any page, you can take a photo of that uh, paper with the help of this translate Google. It will convert it in text mode and automatically convert it in your regional language also. This is the best facility provided by Google Lens. Okay. So you should be aware about these types of tools. Very useful tools are there. Okay. Currency risk means forex, foreign exchange risk from exchange rate fluctuations, export and import losses. Okay. Means when you sold any product with the rate of dollar, already I have discussed a example that you sold a product on a dollar rate that is 89, but when you sold that product on 89 rupees and suddenly what happened, the rate of dollar increased by 6 rupees, means 95 rate is there, means you have got only 89 rupees per dollar from the company. Means this type of loss will be occurred in these situations. Okay, but if this loss can be bear, but what happened when you have decided that you will sold the product on $89, and at the time of delivery, what happened? The rate get down. Means 81 rupees uh, rate is there of dollar. What will happen? You will be loss of 8 rupees. The other country organization will pay you in the dollar. Okay, and you will get the rate of 81 rupees Indian rupees per dollar. This will be a huge loss because import and export transaction is always on high level. They are in the figure of 9 figures, 10 figures, not in the figure of 7 to 8. Always upon above 9 to 10 digit figures, means in the crores. Okay, how to manage management of this risk? So forward contract is there. Forward contract means you have to fix the amount that you have to sell that product on Indian currency and not on foreign currency, means in dollar. Okay, means you will get the amount in Indian rupees with the help of dollars. Okay, means whether the rate of dollar is decreased or increased, there is no benefit or no losses. Okay, you don't have any fear. So forward contract is there before to start production or to provide supply to the organization the products in exports and import system. Swapping system is also there, that when you are exchanging few goods, your exchange rate will be fixed before to start swapping. Natural hedging, just like we have discussed in share market hedging, natural hedging is also available to fix your risk in the in this mode. Interest rate risk, risk from changes in interest rate, for example, higher loan cost and bond value decline. Higher loan cost, higher loan always be on lower interest rate, because the interest rate, the interest amount is on higher level. So instead of to giving small loans to different organizations or persons, finance companies or bank are interested to invest on big project. For example, to provide loan to the builder who are building a town planning, or for a dam proposal, or for building or construct roads for government, or constructing bridge for governments on the roads, and all the government offices will be constructed by the private builders. So banks also provide high level loans and low level interest rate, on low level interest rate, because they will get the profit from a single entity. or organizations. Bond value decline means when you purchase bonds, securities from government, the value of bond will be declined. When a government bond is there, you are totally secured. But private bonds, what about private bonds? You will be declined by the organizations. So there is a risk. And how to manage this risk? Interest rate swaps means swapping of interest rates when a organization have taken loan from a bank and the interest rate of that bank is on higher level, he will switch that loan in another bank. Another bank will repay the amount of previous banks. Okay. In this way, swapping will be there in interest rate. And duration matching means matching the duration will be help in interest rate risk. Business risk from operating uncertainty. For example, demand changes and competition means few companies sell their products to another company, but when the demand getting down, there is a risk. Okay, how? Because of competitions, because of our rate of that product, every company will try to get products on less price, discount price. So far, they will give offers to the consumers. Okay, especially this is happened in supermarkets just like DMart, Vishal Mart, Tata's Mall, and other malls. Management, cost control, and diversification. Cost control. If your demand is less, then you should have to analyze why our demand is less. So you should have to control operational costs. So the cost of your price will be less. Okay. And other is diversification means to divert your products rates from another companies. Business risk, broadly defined, business risk management is concerned with possible reductions in business value from any sources. Business value to shareholders as reflected in the value of the firm's common stocks depends fundamentally on the expected size, timing, and risk variability associated with the firm's future net cash flows, cash inflow, less cash outflows, unexpected changes in expected future net cash flows are a major source of fluctuations in business value. In particular, unexpected reduction in cash inflows or increase is in cash outflows can significantly reduce business value. The major business risks that give rise to variation in cash flows and business value are price risk, credit risk, and pure risk. What is price risk? Now, I would like to explain price risk refers to uncertainty over the magnitude of cash flows due to possible changes in output and input prices. Output price risk refers to the risk of changes in the prices that a firm can demand for its goods and services. Input risk refers to the risk of changes in the prices that a firm must pay for labor, materials, and other inputs to its production process. Analyze of a price risk associated with the sale and production of existing and future products and services plays a central role in strategic management. In price risk, we have seen that output price risk and another is input price risk, means related to commodity price risk, exchange price rate risk, and interest rate risk. Other risk also we have discussed about credit risk and pure risk. Pure risk means damage to assets, legal liabilities, worker injury, and employee benefits. Three specific types of price risk are commodity price risk, exchange price risk, and interest rate risk. Commodity price risk arises from fluctuations in the price of commodities such as coal, copper, oil, gas, and electricity that are inputs for some firms and output for others. Means few companies are using these sources as a raw material and another companies are taking it as a for the purpose of output. Given the globalizations of economic activity, output and input prices for many firms also are affected by fluctuation in foreign exchange rates. Output and input prices also can fluctuate due to changes in interest rate. For example, increase in interest rate may alter the firm's revenues by affecting both the firms of credit allowed and the speed with which customer pay for products purchased on credit. Changes in interest rates also affect the firm's cost of borrowing funds to finance its operations. Now, credit risk, the risk that a firm's customers and the parties to which it has lent money will delay or fail to make promised payments is known as credit risk. Most firms face some credit risk for account receivables. The exposure to credit risk is particularly large for financial institutions such as commercial banks that routinely make loans that are subject to risk of default by the borrower. When firms borrow money, they in turn expose lenders to credit risk. That is the risk that the firm will default on its promised payments. As a consequence, borrowing exposes the firm's owners to the risk that the firm will be unable to pay its debts and thus be forced into bankruptcy. And the firm generally will have to pay more to borrow money as credit risk increased. Another risk is pure risk. The risk management function in medium to large corporation and the term risk management has traditionally focused on the management of what is known as a pure risk. The major types of pure risk that affects businesses including first, the risk of a reduction in value of business assets due to physical damage, theft, and expropriations. For example, seizure of assets by foreign governments means you are unable to repay your loan and you have agreement with that company or organization or bank. What will happen? They will seize your property which you have already bind in the agreement. Means that company will collect your properties from yourself. Second, the risk of a legal liability for damages for harm to customers, suppliers, shareholders, and other parties. Third, the risk associated with paying benefits to injured workers under workers' compensations laws and the risk of legal liabilities for injuries or other harms to employees that are not governed by workers' compensation laws. Fourth, the risk of death, illness, and disability to employees and sometimes family members for which businesses have agreed to make payment under employee benefit plans, including obligations to employees under pension and other retirement saving plans. I have already discussed that if you have taken general insurance of your employees, then you will be saved your money. Okay. Otherwise, if you have not taken insurance, you will be get higher and higher losses if any accident is occurred in your operation system. Another personal risk is there. The risk faced by individuals and families can be classified in a variety of ways. We classify personal risk into six categories: earning risk, medical expenses risk, liability risk, physical asset risk, financial asset risk, and longevity risk. Earning risk refers to the potential fluctuation in a family's earnings, which can occur as a result of a decline in the value of an income, earner's productivity due to death, disability, aging, or a change in technology. More generally, changes in interest rates affect value through their effect on the present value of the firm's net cash flows as reflected in the value of the firm's assets and liability. A family's expenses also are uncertain. Health are cost and liability suits, in particular, can cause large unexpected expenses. A family also faces the risk of a loss in the value of the physical assets that it owns. Automobiles, homes, boats, and computers can be lost, stolen, or damaged. Financial assets value also are subject to fluctuations due to changes in inflation and changes in real value of stock and bonds. Finally, a longevity risk refers to the possibility that retired people will outlive their financial resources. Often, individuals obtain advice about personal risk management from professionals such as insurance agents, accountants, lawyers, and financial planners, which convey you to how to make your risk lower. Comparison of a pure risk and its management with other types of risk, that how much of this focuses on pure risk and its management, including the use of insurance as a tool to reduce risk and finance losses for businesses and individuals. The framework that we present for managing risk, however, is very general. It can be applied with little or no modification to other types of risk. In addition, our detailed discussions of insurance markets and comparisons of insurance contracts to the tools used to reduce other types of business risk will help you understand the rich variety of risk reduction methods available in modern risk management. Common but not necessarily distinctive features of pure risk include the next one: losses from destruction of property, legal liability, and employee injuries or illness often have the potential to be very large relative to a business resources, while business value can increase if losses from pure risk turn out to be lower than expected. The maximum possible gain in these cases is usually relatively small. In contrast, the potential reduction in business value from losses greater than the expected value can be very large and even threaten the firm's viability. Second, the underlying causes of a losses associated with pure risk, such as the destruction of a plant by the explosion of a steam boiler or a product liability, suits from consumers injured by a particular product, are often largely specific to a particular firm and depend on the firm's actions. As a result, the underlying causes of these losses are often subject to a significant degree of control by business. That is, firms can reduce the frequency and severity of losses through actions that alter the underlying causes. For example, by taking steps to reduce the probability of fire or lawsuit. In comparison, while firms can take a variety of steps to reduce their exposure to vulnerability to price risk, the underlying cause of some important types of price changes are largely beyond the control of individual firms. For example, economic factors that cause changes in foreign exchange rates, market-wide changes in interest rates, or aggregate consumer demand. Third, the business commonly reduce uncertainty and finance losses associated with pure risk by purchasing contracts from insurance companies that specialize in evaluating and bearing pure risk. The prevalence of insurance in part reflects the firm specific nature of losses caused by pure risk. The fact that events that cause large losses to a given firm commonly have little effect on losses experienced by other firms facilitates risk reduction by diversification, which is accomplished with insurance contracts. Insurance contracts generally are not used to reduce uncertainty and finance losses associated with price risk and many types of credit risk. Price risk that can simultaneously produce gains for many firms and losses for many other are commonly reduced with financial derivatives such as forward and future contracts, option contracts, and swaps. With this contract, much of the risk of loss is often shifted to parties that have an opposite exposure to the particular risk. Means you must have to understand and must be expert in transferring risk in your personal life or when you are working in any organization as their entity. 4. Losses from pure risk usually are not associated with offering gains for other parties. In contrast, losses to businesses that arise from other types of risk often are associated with gains to other parties. For example, an increase in input price harms the purchaser of the inputs but benefits the seller. Means loss of one person is the profit of another person's. This is the simple mathematics. Okay. Likewise, a decline in the dollar's value against foreign currencies can harm domestic importers but benefit domestic exporters and foreign importers of US goods. One implication of this difference between pure risk and price risk is that losses from pure risk reduce the total wealth in society, whereas fluctuation in output and input prices did not reduce total wealth. In addition, and as we hinted above, the fact and price changes often produce losses for some firms and gains for others. In many cases, allows these firms to reduce risk by taking opposite positions to derivative contract. Summary of this session is market risk, price fluctuations, credit risk, default risk, liquidity risk, cash availability, operational risk, process failure, legal risk, compliance issue, currency risk, exchange rate exchanges, interest rate risk, rate fluctuations, and business risk due to operating uncertainty. Thank you, all of you, to join with us. Now, this session is over.